Good morning, everyone, and welcome to our seminar this morning on employee ownership trusts and exploring the steps involved in a typical transaction. My name's Stuart, I'm a corporate partner at Clarkslegal. We'll be taking you through the legal aspects of this topic, supported by Adrian Howells, Director in the corporate finance team of Quantuma. Morning, Adrian. And
morning, Stuart. Morning, all.
And Adrian will be taking us through the financial, tax, and valuation aspects of the topics that we're going to cover today. We'll run through the webinar. Would have thought in sort of 30-35 minutes or so, and thereafter we'll field any questions that people may have. And to that end, please use the chat functionality on the GoWebinar software. Thank you. So we'll begin by giving an overview of why we think employee ownership trusts are useful for both exits and for business longevity. And we'll then review briefly the sort of typical structure of an EOT and the key components to that, and then we'll look to explore some of the key processes and documentation, and Adrian and I will discuss around that. So before we start looking at the documentation, it's probably useful just to highlight why employee ownership trusts have come about and some of the key perceived advantages of employee engagement within the business process. They've come around as a result of cross-party support and discussion. A commission reported on them back in 2014 that the benefits of involving employees as stakeholders and true owners of a business generally led to that business enjoying greater employee engagement with the business process, that employees felt more belonging, and therefore the turnover of staff numbers were generally perceived as lower. Productivity was generally reported as being greater in businesses which enjoyed employee participation and ownership. In terms of the sale on of the business, one of the benefits is a continuity of business culture, that the incumbent buyers are very much aligned with the seller's culture of the business, and that in itself is often seen as leading to a seamless succession plan without all the difficulties and perhaps heartaches of trying to marry a targeted business with one that has been acquired by a third-party buyer who very much has their own way of doing things in their own systems and processes to achieve what they want to achieve.
Thank you, Stuart. Yes, I'm going to look at a couple of the advantages from sort of a financial or even a commercial perspective. And my first point around stability of business sort of in a way wraps up much of what Stuart's just alluded to, that continuity of culture, the seamless transition, particularly versus other options for selling your business, such as out into private equity or into trade, where it can be quite disruptive. Under an employee ownership trust, you're very much in control of the sale process. The people coming in to run the business are not new; they are your staff. So the culture stays the same. The business very much on day one post-transaction is the business that it was the day before transaction. So that environment is more stable, and staff will feel sort of better engaged with the business. And of course, that sense of ownership is theirs, and of course they literally own it as well. And that's useful then, and leads into my second point, in that, you know, everyone's now pulling in the same direction. I mean, hopefully in most businesses the staff are pulling in the right direction anyway, but once they all own a portion of the business, actually if you start to face, you know, rocky waters, you know, whether it's in a macro sort of environment like COVID or things like that, i.e. business is starting to suffer performance-wise, actually, because the staff have a vested interest in or even greater vested interest in the success of business than they would have otherwise had as pure employees. Studies have shown that employee ownership trust type businesses do tend to perform better during downturns. From the perspective of the staff coming in who will now be the owners, a number of advantages. So minimal cost to them, although they become the owners of the business, they don't pay for that. We'll come on to that, how the transactions are structured later, but a key point is that staff are not having to put their hand in their pocket to invest, because of course many staff won't have funds freely available in order to do so. There's also a tax-free annual bonus. So at the moment that's £3,600 per employee every year, and no tax payable on that. So again, helps keep staff sort of incentivised and part of the plan. They're also enjoying the upside on a potential sale. As I said a moment ago, they're not paying to come in, but when the business ultimately gets sold on, you know, maybe 5 years down the line, whatever's appropriate, you know, they are then the owners, and so they will get sort of a bit of a, quite to what extent, but an element of windfall when that happens. And again, that sort of focus on a potential exit, as I say, possibly 5 years hence, it can be why, you know, these businesses do well or better during sort of performance downturns. And the final point, though, I want to make is that actually, although the idea is that all the staff own the firm, and that's true, there are still flexibilities within that structure. So as the owner, you don't have to relinquish all of your shares, only the controlling interest. And actually, you know, if you wanted to see to it that the senior management team ended up with a larger proportion of the equity in order to keep them sort of motivated and pulling really hard in the right direction, you know, and from a value perspective, you can use things like EMI schemes still to sort of push a bit more equity value towards senior management.
Thank you, Adrian. And then in terms of the transaction itself, there were a number, I suppose, of key advantages that we typically see versus a traditional trade sale, perhaps. Of course, the sale process should very much be streamlined and sort of take the approach to due diligence as you would expect in a management buyout, really. Those commercial questions that will be asked and raised will necessarily largely be answered by the parties that are buying, and therefore you'd expect, certainly on the commercial element of the business, to have a limited DD exercise, which of course impacts on fees. Similarly, warranty exposure for very much the same reason. And of course, because there is generally more trust and confidence with the historic understanding of the business and the performance of the business, you would expect the seller to have reduced exposure to the sort of ratcheted earnout, deferred consideration elements that a buyer coming to the business with relatively little historic understanding would naturally want to see. And of course, there's generally more certainty, perhaps, for a seller that their legacy will continue going into the future with a management team that are less likely to radically change the culture, the composition of the target company, whereas on an arm's length sale, once the deal's done, you don't know what the plans for restructuring that particular target may look like to fit into a buyer's group.
Thank you, Stuart. So yeah, a couple more advantages in terms of certainly the sale process, and looking at this from sort of a lead advisory perspective, from an M&A perspective. How does this impact what you need to go through as a seller? The first key advantage is that your buyers, of course, are known to you. If you're selling even to private equity, and particularly if you're selling to trade, there is often a lengthy process to be gone through to find the right buyer. So you end up, on endless beauty parades, meeting lots of potentially interested parties, inevitably lots of tire kickers. It's I wouldn't say it's a torturous process, but it's not always fun, and it can be inefficient, even with the best will in the world. Here, you know who your buyers are, they're your staff, and they know your business as well. So, that is a key advantage to differentiate the processes, and leads directly into my second point, which is the control you as the vendor can exercise over the process, because you're now dancing to the beat of your own drum, if you like. You've chosen to go down the EOT route. If you want to go quickly with it, so long as your advisors and your lawyers can go quickly with it, and you can get this accomplished very swiftly indeed. Equally, if you want to pause on the process or take a longer time through it, there isn't sort of the buyer banging down your door to try and get this done quickly. You are very much in control of the process, and so perhaps that therefore reduces some elements of stress around the process. As I said before, you can stay involved in the business. You don't have to sell 100% of the shares to your staff, so long as you hold no more than 49%, and the trust obviously must hold 51%. The trust must be in control. That's the key test. You can actually stay involved. I mean, you won't have as much day-to-day control, of course, because the point is you're meant to have lost. You must lose control of your business to a degree, but you can have representation, and you can retain obviously a value interest in the business going forward. And then finally, and sort of the big draw for a lot of people, and particularly at the moment where there is talk about increasing the capital gains tax rate potentially as soon as a month away, almost to the day, up to sort of perhaps income tax rates of 45%. So, a hugely material tax bill for selling your business potentially from early March. EOTs are tax-free if you structure them correctly, and of course, your advisors will help to ensure that is the case. So essentially, what you sell the business for, you keep in your pocket. These, as Stuart said, these schemes are government-backed. It's got cross-party support. The government is keen that EOTs become much more of sort of the mainstay of the UK sort of commercial landscape, and so for that reason they don't take tax from you when you sell your business.
Thanks, Adrian. So just highlighting a sort of typical transaction really, is Adrian explained very much a process where the sellers are in control of not just the timetable of events, but also packaging. And I think packaging is a good word to describe how a seller would or should look to present the sale process. So you would expect the sellers to prepare a SPA. You would expect the sellers to prepare the trust deed initially in consultation with senior management, prepare a data room, due diligence, and obviously disclosure documentation. And we suggest that people prepare this as a sort of pack really, to hand over to the management team and discuss with the management team. They then obviously should go and take advice. The trustees must ensure that they take advice and understand it. And then there's a discussion around any finer detail to conclude the documentation. So it's very much a collaborative approach to control handover, rather than as is typically the case, them and us until we complete on our typical trade sale. So, simple overview: you have the sellers in terms of protagonists. You have the sellers, the selling shareholders. May well be founders, may be other sellers. There may well be option holders, existing EMI or CSOP option holders that are triggered by the sale event. As Adrian says, it's a qualified interest. It's more than 51% the trust must end up with on completion. They then sell their shares to a trust. That trust is typically made up of trustees who may well be the blend of senior management, finance director, possibly a corporate trustee, the purpose of which is that they will meet perhaps 3 or 4 times a year, review the financial performance of the company, see how that sits in terms of the repayment obligations under the purchase agreement that the trust has entered into for the shares, and authorise the release of funds under the purchase agreement, and perhaps the payment of bonuses out to the beneficiaries, who are an unascertained class of people, being the employees for the time being, or from time to time, of the company. I've talked about how share options can be triggered. Existing share options can be triggered, and as Adrian rightly said, there is nothing prohibiting you from establishing further share option schemes, or the trust issuing subsequent share option schemes once they take ownership of the shares. And in some circumstances, bank funding can be used to accelerate the completion payment. And what I would suggest, it's a shameless plug, but what I would suggest is that if you were interested in understanding how bank funding may operate in a little bit more detail, this is the second webinar that Adrian and I have put together. The first one was in conjunction with Virgin Money. Jonathan from Virgin Money spent quite a bit of time talking through how a bank would perhaps look at funding those. So I would encourage you to go to our respective websites and look those up. And if you have problems with finding those links, please let us know. We'll happily make them available for you. Going back to overview of the typical transaction, there are a number of tests. We've talked about the controlling interest test and the control test that must be satisfied for the EOT to comply with the rules to enable the tax neutrality of the transaction to be maintained. It's also important to understand, and we'll come on and talk about that in a little bit more detail when we get to the trustee, that there are some other tests around equality relating to treating the employees as a group equal and not differentiating between different limbs of the business.
Thank you, Stuart. I'll be candid, there's quite a bit to take in on this slide, so I'm not going to go into it in too much detail. What I'm trying to do here is just outline a bit of a timeline of how a transaction would tend to play out. And I'm starting with preparation for sale, which is something that I think often gets overlooked, and is often underestimated in terms of how important it is. We often get clients come in, looking to sell sort of right away, and that's eminently achievable. Of course it is, but actually spending time ahead of getting into a full sale process, actually preparing for it, can make all the difference to the outcome of a transaction for you, both in terms of it being that bit smoother, but also it can positively influence the value that you ultimately achieve on sale. So that's very much in your interests. EOTs, this is particularly important for an employee ownership trust because, candidly, they are not suitable for all businesses. It is the case that the staff obviously take over ownership and, of course, take over control. You as the owner tend to have to step away from control of the business, at least to an extent. And so if you're quite a top heavy, there's only really the founder running the business, and then sort of a relatively inexperienced from a management perspective base of staff beneath that, actually that isn't necessarily suitable to an EOT, because who's going to run business? So as part of your preparation for sale, considerations like that are things that are worth going through. And my advice, and I guess obviously perhaps, but is actually having preliminary conversations with advisors who can talk you through the sort of the various upsides, downsides of the various routes you might take, and how you might best prepare your business for sale. You'll then move on to make a decision about the sale, and there's sort of three key ways to exit, really. The first is selling to a trade acquirer, which might be a competitor or similar. You can get private equity backed deals, often those in the form of a management buyout. And then finally, you've got the employee ownership trusts, which we're talking about here today. There are pros and cons to each of those, which again we've covered in the previous webinar, but we just focus on EOT for the moment. In terms of making that decision, I think it's important to have discussions with the staff. This is not something that can be landed on them at short notice. By the way, next week you guys are going to own the company. No, they need to be involved and consulted early on, and make sure that they're brought into sort of almost that circle of trust, and it's made clear to them what the pros and cons are for them. And again, my advice is get advisors involved at that point who can help manage that message and help manage that transition into a sale process. And there are various points through the sales process. First of all, you need to have a valuation done on the business. If you think about it, if you're selling to private equity or to trade, generally the buyer, in a sense, helps set the price, because it's sort of, the price is what are you willing to sell for, what are they willing to buy for, and are we in agreement? Actually, if you're just selling to your staff, how do you set the price? Well, the answer is you've got to have a formal and, in fact, an independent valuation, which needs to be sort of recognised by HMRC, which moves into getting your tax clearance to make sure that this is all going to get signed off. And from your perspective as the seller, this is key, because of course it's going to ensure that sale can be done tax-free. Then look at funding, and there's one of the disadvantages within EOTs, as again we explained in previous webinars, is it's difficult to get as much value out on day one as you might under a trade sale, albeit overall over a 3-year period you probably end up with more, but you often end up with a lot of value sitting in sort of deferred consideration left on the balance sheet. Although there are, as Stuart alluded to, banks now looking to invest or lend, sorry, to EOT structures. So actually, more value can be brought out on day one. And again, this is all tax-free. We're going to need to work out what the structure is, and again, your lawyers and your advisors will help with that. And that sort of, that what we're doing with funding feeds into that structure. Also, it's sort of, are we having an EMI scheme? Who's going on the board? Those sorts of considerations. And finally, as with all transactions, you move into the SPA, the sale and purchase agreement, which is essentially the contract that executes the transaction. And in a nutshell, that's your transaction done.
Thanks, Adrian. So now we'll just sort of explore some of the key documents really. Obviously, the purchase agreements, the trust deeds, for obvious reasons, and Adrian will give some of his views and explore the all-important valuation. As Adrian says, this is key. One of the points to consider and very important points to bear in mind when considering an EOT is that you have to sell the business for fair value, and that may well prohibit you from or dissuade you from proceeding with an EOT rather than trade sale, where perhaps there's a premium to be received by a potential purchaser who's looking to acquire through trade process. Key documentation, the share purchase agreement, parties, obviously important to give thought to the trust at this stage. Who will the trustees be? Will it be a corporate trust? How will that comprise? And of course, we have to think about the existing structure of the business in terms of who those protagonists will be, and will there be a professional trustee, and will that party play a role, and if so, what's the extent of that role within the purchase agreements. Consideration provisions, again, one of the attractions is to achieve the exit. The deferred consideration provisions will need to be documented, but it does enable surplus cash to be extracted from the value of the business for the benefit of the sellers at the initial stage, and therefore if you are looking to do that, it obviously needs to be documented. Any security that you might want to put in place for the benefit of deferred provisions need to be considered, particularly in light of the existing funding and existing borrowing that may well be put in place by the trust with regards to any bank debt. Payment provisions sort of overlaps. Rather than anti-embarrassment provisions, we mean anti-embarrassment provisions. It is possible to build in a mechanism in the purchase agreement that enables a seller to achieve an element of uplift should the trust look to dispose of the business itself going forward at a greater value. And within the context of anti-embarrassment provisions, we should also consider things like accelerated payment provisions for the deferred consideration in the event that there is a sale on by the trust during the payment term. You would expect to see the usual sorts of restrictive covenants introduced into the SPA to protect the goodwill. It's vital that control is in fact discharged to the trust from the sellers, but as Adrian's explained, it is possible and quite often vital for the seller to retain some element of control and influence in the business itself, because like many businesses, they do have between their ears a large amount of the secret sauce or the trade secrets that make the business what it is, and also for the change management element of this, that a number of employees will want to see those people, those faces in and around the business to give them certainty, certainly for the short term. And again, as with all share purchase agreements, Warranties will be included in that purchase agreement, but as I explained at the beginning, we would expect those to be streamlined from the seller's point. They have to be reasonable. The trustees need to ensure that they are exercising all prudent care and skill in the acquisition, but they should be reduced from those that you might well see on a trade deal for the reasons I've already outlined. The trust document, we'll just start with a bit of law here. The trust deed will in fact be a deed rather than a contract. Just a bit of trivia, really, and a bit of knowledge. The difference between a deed and a contract: a deed is a document that's executed as a deed by parties who have their signature witnessed in the presence of an independent party. You must also complete their details and sign it. Why a deed? The deed, trust law is governed by the 1925 Trustee Act principally, and part of that legislation requires any trust document to be set up as a deed. Limitation argument as well. Deeds generally you have 12 years to sue under them rather than under a contract where typically the limitation period is 6 years. So the trust deed itself sort of follows a fairly sort of standard set of headings. Establishes qualification requirements for a beneficiary, and principally they will be anyone who is an employee of the business. I said earlier that you can't discriminate between beneficiaries. That means that you can't preference the support function over the sales team, for example, or vice versa. It doesn't mean that you have to treat all beneficiaries or all employees equally in the sense of entitlement under the trust. It is possible to treat beneficiaries' entitlement under the trust differently based on seniority, income, salary, number of hours worked, longevity in the business. So you can't treat beneficiaries differently, but you can't be discriminatory. Employee councils, again, depending on the size of the target, it may well be that to promote and foster employee engagement and support communication between the board and the trust, that a council of employees is established to view and express and promote their interests as ultimate owners of the shares. You would expect to see express trustee powers set out in the trust deed. There are implied, quite restricted implied powers of trustees set out in legislation, and typically you may want to explore a broadening of those powers through express provision in the agreement. For example, you may want to give the trustee powers to invest proceeds of income, or give them an ability to dispose of the shares in the event that somebody does come along and offer a large amount of money for the business, where it's in the interest of everybody to consider the merits of that sale. And not unsurprisingly, you might want to consider how trustees are appointed and retired during the life of the trust. Adrian, did you want to take us through valuation?
Yeah, happy to, absolutely. So I think Stuart and I have both made the point probably twice already on this webinar that how important getting a valuation is, and that sits aside then, I suppose, and the reason we're sort of pushing this point, it sits aside to what you see in other transactions. So in a trade sale, you might choose a valuation, or in a private equity sale, there might be an element of that, but that's at your discretion. This is, as it says here, the basis for the agreement of the deal. You know, it is an integral part of the process. It is a requirement from HMRC because, you know, without a valuation, sorry, take a step back. This is a tax-free exit. So what would stop you from deciding that you were going to, sell the business for an inordinate amount of money, put it all on the balance sheet as a fair consideration, and have this all tax-free paid to you? And the answer is the valuation. And for that reason, it must also be an independent valuation. What do we mean by independent valuation? Well, it really means you can't do it yourself. Your advisors can. So if Quantuma are acting as your advisors through an employee ownership trust, we can certainly do the valuation for you and work with you on that, and that will be acceptable to HMRC in the process. And of course, keeping it in-house keeps things slightly smoother as well. But yeah, essentially independent in that you haven't done it, and it will be reviewed and assessed by HMRC to ensure that it stacks up logically. How do you go about valuing a business? There's a number of ways. I'm going to talk about just two here today. So firstly, looking at sort of what I've called comparable price multiples. So what do I mean by that? Look at examples of similar transactions in your industry that have occurred over the last few years, and determine from those, often this isn't published, but there are ways and means of getting information to guide on this, but determine what was paid, what were the earnings for the business at that point, and that way you've got effectively a price earning multiple to guide you, at least in terms of what your business might be worth, taking your earnings and applying a multiple to it. It can also be that you look at listed businesses where actually the price earning multiple is published daily, and however, one would need to apply a very substantial discount to that price earning multiple, because of course generally with these owner managed businesses, it's not a liquid set of shares, it's very illiquid in fact, so there's a huge discount to be applied, but nevertheless that can be used to help define a valuation. Second way is on a discounted cash flow basis, so that is having a sensible, robust set of forecasts for the next few years, what you think the business can achieve, and essentially sort of effectively aggregating the value of all the cash coming through the business over the next sort of 5, maybe even 10 years, and applying a sort of a weighted discount to create a value as at today for that future cash to come. Again, these valuations are something that your advisors will help you with. I just wanted to briefly touch on impact from COVID-19 on valuation. We've been asked a few times, what's that done to valuations? I mean, obviously the economy has suffered terribly over the last nearly year now, and to a degree, some business valuations have gone backwards. Those are generally, though, more for businesses that have suffered significantly during 2020 and sort of find themselves really in a state of stress. Many businesses have performed quite well during 2020. In fact, some have even excelled. Essentially, if you're running a business that has done perfectly okay during 2020, but sort of in spite of rather than because of COVID, then really the valuation of your business is largely unchanged. Similarly, I think certainly what we're seeing in transactions we're working on at the moment, buyers, again, for businesses that have maybe had a bit of a tough 2020, EBITDA's come down 30%, 40%, something like that. Actually, generally that 1 year is being looked at as something of a blip, and allowances are being made for the fact that actually come 2021, hopefully, or maybe later in 2021 now, as the economy starts to reopen, actually you'll be back to where you were. And so sort of buyers aren't applying sort of almost sort of COVID discounts at the moment if you are selling a relatively solvent business. That's not the case, as I say, if your business is stressed or distressed, then that's where value really has gone. So broadly speaking on valuations, therefore, as I say, unless you're in a very bad way, the impact on valuations is not been too significant because of the pandemic.
Thank you. Thank you, Adrian. That was very, very useful. I mean, certainly we at Clarks are seeing a lot of interest in explore how an exit could operate through an EOT, not just because of the tax regime, but I think a lot of people have reached a point, given the last sort of year or so, and thought it would be nice to start planning for the future. We don't necessarily want to be riding a business through this again, and I think it's made a lot of people sort of just evaluate really where they sit with their business, certainly in the owner managed sector, and what they want out of life really. But thank you. We do have a number of questions, so I will read those out and do my best to answer them, or refer them over to Adrian. One question we've had in, did we say that funds, or sell, and I guess by funds we mean sale proceeds, come out tax free as opposed to taxable under capital gains tax regime? Adrian, did you want to answer that one for us?
Yeah, sure. And that's one of the key advantages, is that it is a tax-free exit. So capital gains tax at the moment, if you're selling business at the moment, you talk about nothing but capital gains tax, particularly during this period where it's looking to change. Current rate is 20%. The threat, whether it happens or not, but the threat is that it moves to 45% on or around the 3rd of March. EOT is tax-free. So even at the moment, you are saving a substantial amount of money by using an EOT, but potentially come March, you are saving an astonishing amount of money by using an employee ownership trust. As I sort of alluded to when I was talking earlier, this has got cross-party government support. It is something that they're quite keen on. And actually, if you think about Boris talking about sort of trying to level up the economy and things, actually this can form part of that road path. So yeah, the government are keen on them, and they are tax-free, which is great news if you're selling.
That's great, Adrian. Thank you. I think it might just be worth just making the point there, Adrian. I think I'm right in saying that if you sell a qualifying interest, so more than 51%, but you retain a balance of those shares as a seller when selling into the EOT, as I understand it, I think you get it's tax neutral for the first tranche. But if you then decided to sell a further amount after that first tranche, I'm not sure that second tranche of shares would necessarily qualify for the tax neutrality under the EOT rules. I think I'm right in saying that.
Yeah, I think it will also partly depend on who you sell it to. Certainly, if you sell it to, let's say you hold 49%, and in 5 years' time the business sells to trade. The 51% held by trust, the employees will be taxed at capital gains tax rates, or possibly even income tax rates. And you then, as the vendor holding, as I said, in this example, 49%, that would then be a capital gains tax rate. So yes, in essence, to sort of lock in 0% tax, your most efficient route is a 100% share sale, if that's suitable for you, but that won't be for everyone.
No, and certainly I've come across clients who have sold for multiples of millions and realised that it made more sense when they considered their wider tax planning structure, that realising all of the proceeds through an EOT sale and realising that in cash wouldn't necessarily be the best route for them. Selling a interest to give them enough for comfortable retirement and to do the other things that they wanted made more sense, and then perhaps holding that balance of shares in a form of trust under their wills was better for an inheritance tax perspective. But again, I make that point. We're not tax advisors, but I do make the point that when you are looking to make the disposal or considering this structure, you sort of need to think broader than just the impact of no CGT on a sale of your shares, but how that may influence and impact on your estate planning and all of those things as well. Okay, thank you, Adrian. Another question. We mentioned senior staff or management can take part to own a larger share. How can this be structured, and does it cause any problems if that senior management includes relatives of the seller? I'll have a go answering this one, Adrian, and please feel free to jump in. Yes. In terms of the beneficiaries of the trust, you can differentiate in terms of seniority and, as I say, longevity of service in terms of what individual element of return a beneficiary may well get under the trust itself. And also you can put in place EMI or other option schemes for the benefit of key employees in the ordinary way. I mean, in terms of problems, if that senior management includes relatives of the seller, I think from the rules in respect of the EOT disposal process, what's key is that you have relinquished control of the business on a sale, and therefore if you have people connected with you that are still controlling that business, that may well be an issue. But in and of itself, having a relative who is a senior management of the manager to the business and rewarding them in a way that's clear and transparent in line with the rules, but they're getting more because of their seniority, in and of itself isn't prohibited. Adrian, I don't know if you had anything to add.
I think you covered that quite well. Yeah, I'm nothing to add on that one.
Okay, thank you. We've got quite a few questions, so I'll do my best to sort of rattle through them. One of our points: once an EOT is set up, the trustees have a duty to act in the best interest of all employees. Correct. What flexibility is there to treat employees differently without discrimination, e.g., bonuses, EMIs, etc.? Yeah, thank you for your question. Again, it is possible to differentiate in terms of individual entitlement from the trust based on clear and transparent criteria. What you can't do is you rightly point out that you can't discriminate on different classes of employee or different groups of employee, but you can treat people differently based on length of service, seniority, and those things. But that does need to be very well and clearly drafted in the trust deed itself. Adrian, I don't know if you had anything you wanted to add.
Very legal question, Stuart. You definitely want little to add to that, I'm afraid.
Okay. A question here, a very rough guide to sort of costs involved in setting up a trust and sale process. I mean, to the person that's raised that question, if you'd like to email both or either of myself or Adrian, then I can we can take you through what we think fees may well be depending on circumstances, because it's about how much involvement you need in terms of the pre and the post element of the transaction, how complicated the business is there going to be some bank funding, how much support would you need in terms of the valuation, all those things. I'm not ducking your question. I would happily give you that further detail, but we do need to find out a little bit more information before I can give you a definitive answer there.
Yeah, it's going to vary by, each business will be different and unique. So, candidly, so will each price, I suppose.
Yeah. But I would make the point that, you know, they are in toto cheaper than proceeding with a trade sale for some of the reasons that we've explained in the structure. And of course, if your advisors approach it in the way that I suggested, well, certainly what I consider to be the best way to deliver the process. Another question, in my experience, an EOT transaction does not necessarily involve change of executive management. The trust is a board representation, but that is often the interchange. Any comment? Yes, I would agree with that. I would agree with that. I mean, it depends. I mean, it depends on how involved the seller is in terms of the board and the size of that board. But fundamentally, yeah, what we don't want to do is upset the apple cart in terms of the engine room that is the decision and strategy of the company that makes it the success that it is. And the trust, whilst we are selling to a trust, and the trustees do have very clear obligations set out both in law and in the trust document itself, fundamentally the trustees' responsibilities are to make sure that the asset is being managed well to deliver the trust objects and to ensure payment down to both the seller to comply with its legal obligation under the purchase agreement and the interest of the beneficiaries that are the employees and pay them their bonuses. Another question, in our experience, is are we seeing full exits rather than partial exits? Yeah, good question. I mean, it sort of depends, really. I mean, most of I would say it's probably a mixed bag, because it just depends on the individual circumstances and their wealth and what they're looking for in terms of an exit. And is it better to leave some shares in a family trust so they benefit from property relief, business property relief, potentially under under their wills trusts, and it generates income that can pay the grandkids or the kids' school fees, all of those things? Is that better than having extra another few million in cash on day one? Well, arguably yes, because if you go under a bus, then you know, with cash rather than shares, there is a very different tax treatment to sale proceeds rather than owning shares. So, I mean, it just depends. It just depends. Adrian, any comment on that?
Yeah, well, echoing a lot of what you've said, Stuart, we're certainly seeing a mix. I think, you know, selling your business when you're an owner manager is a very personal process anyway. And the decisions around that, therefore, are very human sort of process decisions. And you know, so it is a case of, you know, circumstances. And so yes, we've seen some where people want, you know, a full exit, you know, versus those where, you know, actually rather retain a stake. I mean, often you see the latter where actually the business is still maybe growing, so maybe it's in slightly earlier stage in its life cycle, and so, you know, we'll take a chunk of value out now tax free, but actually you know, my assumption is that the percentage that I'm retaining will be worth that bit more later on, so that even if I'm not able to get such a tax efficient exit on that portion, actually it's accrued in value so much that you know, because the business is growing, that's worth it. And so it's sort of it's a bit of a hedged bet, I suppose.
Thank you, Adrian. A question here, interesting question. Implications of a company being owned by an EOT for anti-money laundering purposes. Well, I think the anti-money laundering legislation applies equally. Just because of a trust involvement doesn't necessarily mean that you can't identify the true beneficial owners of the business. In fact, identifying the true beneficial owners of the trust when you're dealing with employees is quite straightforward, because you would have details of those employees through payroll. you would be able to identify those beneficiaries. So the person that raised that question, I hope I've answered it. If I haven't answered it or I've misinterpreted it, please do send me an email and I'll do my best to give you a better answer. And another question, difference between tax neutral and tax free. I'm sorry, we're talking about tax neutral and tax free. Adrian, would you like to explain the difference?
I think commercially there isn't much of a difference, to be honest with you. I think it's sort of getting into the weeds of technical terms, to be honest. So it's not a particularly clean answer, but as I say, I think there isn't a huge difference actually.
Yeah, for the purposes of this webinar, what we mean is there is no tax on transfer. Another question. I'm a shareholder of a business. I've received a trade offer. I'd like to be able to share some of the proceeds with employees who aren't currently shareholders. Could I sell a majority of my shares to the trust now, and then the trust sell to the trade buyer in 3 to 4 months' time, which would then enable my employees to take a share of the value? In principle, yes, but of course, what you have to bear in mind is that once you've sold those shares to the trust, you have lost control of those shares, and therefore you have no guarantee that the trust itself would dispose of, or it would be, would dispose of those shares to that trade buyer. They would need to, the trustees that is, would need to exercise independent skill, care and judgment and ascertain whether or not it is in the best interest of the beneficiaries as a whole to make that disposal. So in principle, yes, I think you have to be careful about how you try and control that process because of the requirements of the rules to benefit from the tax points we've discussed. Adrian, any questions or comment there?
Yeah, I'm trying to work out quite how it would work, because your, as I sort of noted earlier, your consideration is often through deferred consideration, and so at the point that you sell to the trust, you aren't necessarily receiving much more than the cash that sits on your balance sheet already, albeit you'll get that tax free. So then, one of the advantages, obviously, for the then employees is that ultimately, when the business is sold, they'll get this sort of windfall, as I described earlier. But of course, that only happens if the deferred consideration has been settled. Actually, your own deferred consideration will sit ahead of them. And so essentially, if you sell for an amount to your employees, the only way they get a windfall then is if the trade buyer essentially pays more than you sold into the trust for. Otherwise, essentially, that the consideration from the trade buyer is essentially used just to mop up your own deferred consideration. And so, it's not impossible, but as Stuart says, you've sort of lost control of the process. And one way you might be able to maintain some influence on the process is, of course, if your staff are looking to maybe get a mini windfall out of this. And actually, in that particular scenario, that might be quite tricky. Having said that, you might be able to put bank debt in so that you can get some of your consideration accelerated up front, and then it depends on whether your buyer then is willing to sort of take on that bank debt. I mean, unfortunately, generally they'll look at it and want to do cash-free, debt-free, which means that they'll knock the bank debt back off again. So it's all without sort of exploring it in more detail, and I'm very happy to do so, by the way, but instinctively it will feel slightly circular. Obviously, if you got it to work, yes, there's a tax benefit, but it's that middle ground where you've done the EOT piece. How do you then get the trust to sell to the trade buyer, as Stuart says, is just the risk you need to sort of think through. I think I don't think it's impossible. I just think it's challenging.
Yeah, thank you, Adrian. I'm just conscious of time, and we've got one two more questions. Or three more questions that we'll try and rustle through. But then I think we must call it a day. Feel free to email us though. We'll happily respond to email questions. So if there was a partial exit, then the owner can stay involved but can't be included as a beneficiary of the trust. So how is that usually structured? Do we have a trust owning the limited company as seen? Well, a company limited by, okay. So, well, no. I mean, what you would have is you would have the trustees holding, I don't know, call it 70. In this example, Stella retains 25, sells 75%. What you would have is two shareholders. You'd have the trustees representing their 75% interest, holding that on trust for the beneficiaries, and the remaining shareholding being held by that individual. You may well then want to explore having a shareholders agreement in the usual way where you have multiple shareholders, but again, you have to think carefully about how that agreement would work and ensure that the usual consent provisions, majority consent provisions, don't automatically apply where you could give rise to an inadvertent retention of control from that selling shareholder. Another one, presumably the disposal looks at it in the round. If two owners, say 90 and 10% owners, maybe via exercise VM options, and they both sell, the control passes from one bar, but presumably both owners get tax-free, providing all other criteria being met. The person that raised that question, would they like to make contact with both either Adrian or I afterwards? Because I'm struggling to understand how that question, whether that question linked into the previous one or earlier ones, but we would certainly like to talk to you. Another question: how do beneficiaries get the cash from the trust? And we mentioned part of this can be tax-free to the staff.
That's just, I think we're referring there to the tax-free annual bonus. So as I say, it's, at the moment it's £3,600 per annum. That, by the way, isn't going towards paying for their equity. That is a bonus. It's a P&L item. Of course, the business needs to be generating the profits and the cash in order to be able to pay that. That's literally upside, if you like. So if you've got an EOT where there's 10 staff and they each own 10% each, on top of that, they're allowed the 3,600 tax-free per year. In terms then of any other cash to the beneficiaries, that if you were wondering about that, then it's that's obviously on exit, which is something that the trust combined needs to agree on and sign off on. And as I say, actually the exit is not particularly tax efficient for the beneficiaries, save for the fact that they haven't put any cash in up front. So actually, it's sort of almost an infinite gain, strictly speaking. So, but those are the two ways that the beneficiaries get cash from the perspective of the trust over and above their usual salary.
Thank you, Adrian. Right, well, thank you everybody for listening. Thank you everybody for joining us today and asking and sending us the questions that you have. It is an exciting topic, we think so, and it's going to become more and more prevalent, certainly in the next couple of years. If you do have any more questions, please feel free to email either Adrian or I, and we'll absolutely do our best to answer them. If you are interested, as I say, this is the second in a series of seminars around this topic that we put together. Do look on our website if you'd like to view our previous one. If you have problems, again, let us know, and we'll ping through as much information as we links to it if you struggle. we are, as I say, putting together another one on this this topic, exploring some of the wider practicalities that people need to consider. So not perhaps so limited to just the mechanics of finance and legal, which is going to be held. I think I'm right in saying, Adrian, we're going to do that early March. So
rings a bell, the 18th. Is it Thursday, the 18th of March?
I think that's right, mid-March. Sorry. So yeah, if you'd like to do it, you know, we'd love to virtually see you there. You know. But in the meantime, thank you again for your interaction. We hope you and your families are well and continue to keep safe, and we look forward to seeing and engaging with you when we're able. Many thanks and bye for now.
Thank you. Bye.